Hey everyone, Ben Herden from Mortgage Choice Guy here. Today I wanted to talk to you about a strategy that can help you pay your home loan off faster while simultaneously building your wealth for the future. It's called debt recycling. Now most people think that having a mortgage is going to stop them from investing, but for the right client with the right amount of equity, the mortgage can actually be the tool that helps them invest and helps them get in front. So I want to talk to you about how this works and specifically how we can structure the loan to make the process seamless. First, let's have a look at your current home loan debt. In the eyes of the ATO, this is usually considered a bad debt or a non-tax deductible debt. This is because you can't claim the interest you pay as a tax deduction. It's a cost that comes straight out of your after-tax income. On the flip side, you can have good debt or investment debt. If you borrow money to buy an income-producing asset like shares or an investment property, the interest on that loan is generally tax deductible, and it's what we know as a good debt. So what is debt recycling? Debt recycling isn't about taking on more debt just for the sake of it. It's about replacing your bad debt with good debt over time. Now, the basic process is you use your savings or your income to pay your home loan down. You then immediately redraw the same amount as a separate investment loan. And you then invest those funds into assets that will grow or pay you an income. Now, crucially, because the loan split is being used for investment purposes, the interest becomes tax deductible. You can then use the tax refunds and the investment income to pay down the home loan portion, which is non-tax deductible, even faster. Execution and loan structure is absolutely everything. If you mix your investment cash with personal expenses such as groceries in the same account, the ATO may disallow the tax deductions. Your accountant won't be happy and it can get really messy. Now this is where we as brokers come in. To do this properly, we look for a specific type of loan facility that is referred to as a master limit structure. So imagine a large umbrella that covers your total borrowing capacity. Underneath that umbrella, we can have multiple sub-accounts. So for starters, you're going to have the home loan. That will be your first sub-account. Then we might have an investment loan for whatever, $100,000 for example. Now you can borrow up to 80% of the value of your property here. So the more equity you have, the better this is going to work for you. And the more you'll be able to invest and the faster you'll be able to repay the home loan. The beauty of this structure is its flexibility. As you pay down the home loan account, we can simply increase the amount of the investment loan. So if you repay $50,000 off your home loan, we can increase the investment loan by $50,000, and then you've got another $50,000 that you can put into other investments. So we have decreased your bad non-deductible debt and we have increased your good tax-deductible debt, all the while increasing your investments. This allows you to recycle your equity instantly and keeps the tax office happy by keeping the funds in totally separate accounts. Now, an important disclaimer here. As a mortgage broker, my job is to structure your debt appropriately so it's flexible and compliant, but I can't tell you what to invest in. Debt recycling involves investments, so it therefore involves risks. You're attaching this investment to the family home as well. So if the market drops, you're still going to owe the same amount of debt. Now, this is why I highly recommend doing this with a financial planner. They're the ones who are going to help you choose the right investments, whether that be shares or managed funds or EFTs, that are going to suit your risk profile, most importantly. They can ensure the project returns justifies doing this in the first place, and they can help you plan your cash flow so you're not left short. This strategy works best as a team effort, and we do work with other financial planners for other clients to make this happen, and it does work well in the long term. I can handle the loan parts of it, but your planner needs to handle the investment engines and the investment advice. So if you have enough equity in your property and your incomes are good and you're curious if this loan structure is going to suit you, then let's have a chat. Please call myself or someone in the team and we would love to help you out with it. We can then set up the master limit facility so you're ready to go when your advisor decides the time is right. Thanks for watching and we look forward to hearing from you.